what are bank bail-ins? Well, you're probably familiar with bank bailouts from the 2008 crisis and recession that emerged, where the government used taxpayers' money to bail out the banks, which became one of the biggest scandals in modern history. So a bank bail-in then is where the bank can legally take possession of your savings or your deposits and turn it into worthless banking stock. And yes, this is 100% legal. The USA actually passed a law in 2010 called statutory bail-ins, which includes extended powers to the Federal Reserve, the Securities and Exchange Commission, and the Federal Deposit Insurance Corporation, otherwise known as the FDIC, whereby bank holding companies and non-banking holding companies can be placed in receivership under the control of the FDIC. The IMF, my least favorite organization in the whole financial world, as many of you know, then produced a paper on the 24th of April 2012, which was all about bail-ins. I'll put that on screen now so that you can look at that if you want to read through that. So let me read this out to you. This paper published on the 24th of April 2012, where a new plan was created for solving banking crises. This included a bail-in mechanism that they say, and I quote, aims to ensure that banks, shareholders and creditors pay their share of costs. The key word here is creditors. That means you and it means I. We are bank creditors. And I'll explain what that means in a moment. Because just 11 months after this paper was published, we had the first bail-in, which took place in Cyprus in March of 2013. So what happened then? Well, the bank basically bailed in 21,000 savers who had more than 100,000 euros in their bank account. So these depositors here saw roughly 50% of their savings converted to equity, making them 81.4% owners of an insolvent bank. In other words, they got scammed. Oh, but we're not actually allowed to say that word, that it was a scam. Instead, let me just read out what the official terminology that we're permitted to use here. Hold on, I've got it right here. A financial reallocation of collateral to neutral assets. Let's just change that up a little bit. Let's use the word useless instead of neutral. A financial reallocation of collateral to useless assets, I think, is a lot more fitting, because let's be honest, who wants to own a bankrupt banking stock? I don't, do you? But Neil, how is this legal? I hear you cry out. Well, when you or I deposit money into a bank, that money is considered a deposit. This is the key word, deposit. And technically and legally, this deposit then becomes the ownership of the bank, where they issue you a promissory note, or if you want to make it even more simple, an IOU. As far as the bank's concerned, you have made a loan to them for which they give you interest. There's the key thing there. If you're receiving any interest on the money you've deposited, even if it's 0.000000001%, that is considered an unsecured loan from you to the bank. And just like any unsecured, keyword here is unsecured loan, that loan is at risk. So after the success, and I'll show you who uses that word in a moment, of the bail-in in Cyprus in 2013, bail-in laws passed pretty much everywhere where we have modern banking systems. In Europe, the Bank Recovery and Resolution Directive, BRRD, was introduced in 2014 across the then EU 28, which meant the 28 countries in the EU in 2014. And this policy included a bail-in mechanism, which they stated at the creation, are you ready for this? This is deja vu again, aims to ensure that banks, shareholders and creditors, including uninsured depositors, pay their share of costs. But what share of costs? Why would a depositor have to take a share of the costs when a bank goes bankrupt? The blame lies with the bank, surely, not the creditors. So let me give you an example here to show the absurdity of this. Imagine that you get in your car and you drive to the mall, and you park your car in the mall and you go shopping for a few hours. When you return, your car's not there, it's disappeared. But there's a note, and the note says, "Hey, Mr. Mrs. whatever, just to let you know, your car has been bailed in because the mall has gone bankrupt. So we've classed your car as a deposit, which we have used as collateral to help with the mall's bankruptcy. So you now own shares in our bankrupt mall. Congratulations." Can you see how absurd this example is? And yet in the banking sector, apparently it's okay. And now you know why I dislike lobbyists so much. If you're getting a lot of value from this video so far, and there's even more to come, can you please do me a quick favor? Just click that like button for me. Just helps the video to get ranked on YouTube. And why not subscribe to the channel if you're not already a subscriber? So for those of you skeptics watching, I know there's a lot of you, and you think, Neil, you're just scaremongering, let me read this out to you. The bail-in was institutionalized in November of 2014 when the group of 20 nations, so this is the G20, including the United States, approved its use through the Financial Stability Board, the FSB. What else did the FSB do? They permitted the priority of the payment of bank derivatives above all other creditors. This is outrageous, ladies and gentlemen. If you don't know about the derivatives market, it's too much to cover in this video, but it is one of the biggest scandals that exists in the world right now. Hundreds of trillions, probably at last guess around $650 trillion exists in the derivatives market. And what this policy says is that when the derivatives market pops, and it will, mark my words, it will eventually pop, the banks and the financial gamblers get paid out before you do. And you've got your politicians to thank for this based on all the lobbying that the banks do. So in effect, with bail-in, they don't steal your money, because I'm not allowed to say that. What they do is they convert it into assets. But in my mind, that's just a smokescreen, because if you don't have a choice, then to me, that's theft. That would be like you walking down the street and someone coming up and robbing you and stealing all the money out of your pocket because the thief doesn't have a watch. And of course, he needs a watch. How else is he going to tell the time? So you call the police, and the police come and they say, yeah, the thing is, this thief didn't have a watch, so there was no way that he could tell the time. San Francisco. Sorry, just had a bit of a cough there. But the police let you know that you still own the watch. You just don't have any control over where the watch goes. And by the way, the watch is worthless anyway. This is the comparison of what's going on right now.